Hello everyone. Today we discuss about the difference between capital structure and financial structure. The term capital structure differs from financial structure. Financial structure refers to the composition or makeup of the entire liabilities side of the balance sheet of a firm. It shows the way in which the firm's assets are financed, and it includes long term as well as short term sources of finance of the organizations. Capital structure is the permanent financing of the firm, presented primarily by long term debts and shareholders funds, but excluding all short term credit. Thus, a firm's capital structure is only a part of its financial structure. Capital structure and financial structure both are different. According to Weston and Brigham, capital structure is the permanent financing of the firm, represented by long-term debts, preferred stock, and net worth. But financial structure refers to the way through which the firm's assets are financed, and it is the entire right hand side of the balance sheet. In fact, capital structure means the financing through long term finance, while financial structure relates to the total financial available for total assets of the concern. Now, capitalizations refers to the quantitative aspects of financial planning, while capital structure refers to the qualitative aspects of financial planning. Capitalizations is an absolute measures, while capital structure is an relative measures. Capitalizations is the total capital arranged by the firm from various long-term sources, while capital structure is the relative proportion of various long-term sources in aggregate long-term capital of any firm. So, the through now we discuss about the distinction between the capitalization and capital structure. Though sometimes used interchangeably, the two terms capitalizations and capital structure differs in their meaning. Capitalization refers to the total amount of fund or capital procured by a firm from different sources, preferably long term. On the other hand, capital structure refers to the respective proportions of various long term sources in the aggregate long term capital of a firm or organization. Now, we discuss about the difference between capital structure and capitalization. So, capital structure coverage, it refers to mix of various sources of capital debts, etc. Scope, it is an overall policy decision about the proportion of various sources of long-term finance. Nature, it is a qualitative decision. Capitalizations and coverage, it refers to all long-term securities, equity, debts, and free reserves not meant for distribution. Scope, it is implementations of policy decisions about capital structure. Nature, it is a quantitative decision. Now we discuss about uh, the reason to avoid default on debenture. So, adjustment of capital structure is necessary to avoid default on debenture. Sometimes the company would become the defaulter if it fails to pay the interest on due dates or fails to pay the principal at maturity on debenture, which compels the company to make certain arrangements with its brokers to purchase the interest coupon and take assets as securities, or it has to appeal to debenture holders to accept new debentures or equity shares or preference shares in exchange for their existing holding. In such circumstances, the adjustment is required in the capital structure of the company. Now, to refund accumulated dividend, if a company has a large accumulated balance of dividend on preference shares, in such case it may enter into agreement with preference shareholders also, either to accept bonds or equity shares or new preference shares against their claim in the accumulated balance of dividend in order to take advantage of their favorable money market. Many companies reduce the dividend rates of their preference shares either by cancelling old shares and issuing new shares also for cash to redeem the old ones by converting the old shares into new shares. Cash bonus may be offered to shareholders to induce the exchanges. The facilities merger and integration. In order to facilitate the merger, the intending companies may be required to readjust their capital structure. The step is generally taken to equalize the intrinsic value of share of different companies to meet certain legal requirements. To meet the legal requirements, sometimes adjustment is to made in capital structure. The company, for example, Indian Companies Act 1956, shortlisted deferred shares. Now we discuss about the reasons for readjustment of capital structure. In initiate capital structure, however planned, can never fully anticipated the effect of dynamic economic trends, and as a result capital structure in a company is subject to certain adjustments. Such adjustments arises due expansion, readjustments or recapitalizations to face special problems in organizations. To the financial pattern may be outmoded by changing conditions in the capital. The money market, the sound of successful administration of the financial plan is based on effecting a balance that is intended in incorporate the balancing need of business operations. And readjustment of capital structure involves the systematic and satisfactory arrangement of various types of securities so as to pursue the objectives efficiently. Now, uh, in order to internal funds is placed first and equity capital is on last position according to the theory of management. Reliance primarily on retained earning is because management possesses informations about their internal resources and it does not want to bind itself in rules and regulations of capital market. The theory does not support the concept of optimal capital structure. Management raises funds as and when needed in a certain order. It depicts that cost associated with an internal fund is minimum and cost associated with equity funds is maximum. According to the theory, management arises or raises finance in a particular order, as the name of this theory implies, that is, first get finance from internally generated funds, that is, retained earning, second, if insufficient retained earning or no retained earning, then from issue of debts, third and last is from the issue of equity shares. Now, the in the word of the manager of corporate financing, operation must always think of rainy days or in the emergencies. The general rule is to keep your best security or some of your best securities till the last. In normal times, equity shares may be issued in times of emergencies. Debentures carrying fixed interest can be issued. So, simplicity of the capital structure. In devising the capital structure of the company, the management should avoid the media of multiplicity of securities. Only one type of share and debenture would be issued so as to be easily understandable to investor and easily manageable by the company. Legal restrictions in decision about the capital structure of the company, the management has to take into account the legal restrictions regarding the issue of different kinds of securities. In India, for example, banking companies are not allowed to issue any other type of securities for raising of funds except the equity share capital act on account of Banking Regulation Act. Now, at other period, investor may be interested in earning high speculative income. It will be appropriate to raise funds by issue of equity share. Thus, the financial management must consider the market conditions to determine a balanced capital structure. So, market conditions, another important factor which determines the capital structure is the market conditions. The issue of securities must be in accordance with the market condition. The investors' psychology must be studied before issuing the right type of securities in the market. In time of depression, the investor will look more for safety than to income. In such cases, it will be appropriate to raise funds by issue of debenture. Now, therefore, in raising the capital, the company must be incurred the lowest cost in terms of interest, dividend, commissions, brokerage, etc. Further, it should maintain the proper relationship of earning to the price of the shares. The company should adopt the suitable mix as to minimize the aggregate cost of financing, that is, selling the debenture at lowest expenses and highest in raising the equity capital also. Now, the cost of financing. The cost of financing the business have a great influence on the financial structure of the company. In raising the capital, company must take into account the types of securities to be issued, dividend, interest under the writing commissions, brokerage, listing, charges, etc. Because these factors will constitute the cost of financing also. Now, the investors who are already to take risk for higher income, capital appreciation, and want to acquire control over the affair of the company may go in for equity shares. Thus, the capital structure of the company must suit the requirement of different class of potential investors also. The investors who prefer safety to investment and stable income usually go in for debentures. Preference shares will be preferred by those who want a higher and stable income with enough safety to investment. Attitude of investors also should be taken into account at the time of revising the capital structure of the company to suit the requirements of different classes of potential investors. Different types of securities are included in the capital structure of the company also. Now, this makes this capital structure rigid because the payment of the fixed interest and or dividend, these securities may be held in standby in times of emergencies or for further expansions. Hence, at this inception, equity share should be issued because they do not impose fixed liability on the company. If the company requires additional capital for a specified period, then redeemable preference shares or debenture may be issued to tend flexibility to the capital structure. And elasticity in the capital structure is another important factor of sound financial plan. Financial structure should not be rigid. It must to provide for expansion for the further development or to make it feasible to reduce the capital when it is not needed in the initial stage, and company should not issue debentures and preference shares also. This is because this can easily be repeated as soon as company's financial position improved. In such case, share capital should not be raised because share capital expect redeemable preference shares capital cannot be repaid during the lifetime of the company. Even company is in positions of its own fund. So the period for which the finance is required, must also be taken into account while determining the capital structure of the company. In case funds are required, say for 5 to 10 years, it will be appropriate to raise them by issue of shares also. This is because the company will have the capacity to pay the interest on debenture out of the profits so earned. On the other hand, if the funds are required for non-productive purpose and providing more welfare facilities to the workers also, the company should raise the funds by issue of equity shares. Now, at the same time, at the time of devising the capital structure of the company, the management must take into account the purpose for which the funds are being raised. In case funds are required for some productive projects, mechanism or mechanizations of industry, the company can raise the funds by issue of debenture also. Now, nature of enterprise. While determining the capital structure, the nature of business should also be taken into account. A capital structure to manufacturing company may be differing from these of trading and financial organization. These enterprises differ in regard to the amount of investment, risk involved, trade cycles, and nature of the competitions, etc. And this is because the debenture holders and preference shareholders are usually not given any voting rights as enjoyed by the equity shareholders. This is how to promoters or management controls the affair of the company. So, desire to control the business. The second factor which affect capital structure of the company is management policy of desire to maintain control over the affair of the business. For this purpose, they raise a large promotion of funds by the issue of debenture and preference shares. So that's for the video, my friends. If you like my videos, please subscribe my videos, share and comments on my channel. Thanks a lot for watching my video.